Hello everyone and welcome back to the channel. Happy 4th of July to all of our viewers celebrating in the United States. While many are out enjoying barbecues and fireworks, the crypto markets never sleep. And today they decided to throw a few fireworks of their own, just not the kind we were hoping for. We're seeing a sea of red across the board. A rather unexpected turn of events on a day typically marked by low volume and quiet trading. So the big question on everyone's mind is, what is going on? Is this a genuine shift in sentiment, or just some holiday volatility shaking out weak hands? We're going to break it all down for you today, looking at the macro environment, the key price levels for Bitcoin, Ethereum, Solana, and XRP, and what we can expect heading into the weekend and beyond. But before we dive deep into the charts, I need to give the all-important disclaimer. Please remember, I am not a financial advisor. This content is for informational and educational purposes only. The crypto market is highly volatile and carries significant risk. You should always do your own research and consult with a professional before making any investment decisions. Your capital is at risk. Now, with that out of the way, let's get into the state of the market. Overall, the market sentiment today can best be described as cautiously neutral, but with a distinct bearish tilt developing over the last 24 hours. For the past couple of weeks, we've been in a state of consolidation after a very strong run-up in June. The bulls and bears have been locked in a tight battle, but it seems the bears are starting to gain a slight upper hand, pushing prices down below some key technical levels. Volume is, as expected, thinner than usual due to the US holiday, which can sometimes exaggerate price movements. However, the dip feels a little too coordinated to be dismissed as just low volume noise. It seems to be a reaction to a confluence of factors, both from within the crypto space and from the broader macroeconomic landscape, which is where we really need to start our analysis. The biggest story impacting all risk assets right now, including crypto, is the latest inflation data that dropped earlier this week. The US core PCE, the Federal Reserve's preferred measure of inflation, came in slightly hotter than anticipated. The market was pricing in a continued, smooth decline in inflation, paving the way for the Fed to potentially signal a more dovish stance in their coming meeting later this month. However, this higher than expected print has thrown a wrench in those plans. It's reignited fears that inflation is stickier than we'd like, and that the Fed may have to keep interest rates higher for longer, or at the very least, push back their timeline for any potential rate cuts. This narrative of higher for longer is poison for assets like crypto, which thrive in low interest rate, high liquidity environments. So, that's macro pressure number one. Macro pressure number two is a bit more nebulous but equally important, the global regulatory environment. We're hearing whispers out of Brussels that discussions around the next phase of the Global Digital Asset Framework, or GDAF, are progressing well, with a focus on creating clear guidelines for DeFi protocols. That's a long-term positive. However, in the short term, the US side of the equation remains murky. We've seen a distinct lack of legislative progress, and the ongoing regulation by enforcement approach continues to create a cloud of uncertainty. This disparity between progress in Europe and gridlock in the US is creating a fractured global landscape, and capital is hesitant to make major moves until there is a clearer, unified path forward. This regulatory overhang is acting as a significant headwind, preventing the market from achieving true escape velocity. So with that context, let's see how this is all translating into the price of Bitcoin. As of the time of this recording, Bitcoin is trading at approximately $92,150. This represents a drop of about 3% over the last 24 hours. The key story for Bitcoin right now is its rejection from the $95,000 resistance level. We tested that level 3 times over the past week, and each time, sellers stepped in with force. $95,000 is a major psychological and technical barrier, and failing to break through it has emboldened the bears. Now, Bitcoin has fallen back to a very critical support zone. We are currently sitting just above the 50-day moving average, which has acted as a reliable floor for the price during this entire uptrend. A decisive close below this moving average, which currently sits around $91,500, would be a very bearish signal. It would suggest that the short-term trend is shifting downwards. Below that, the next major support level to watch is the psychological $90,000 mark. If we lose $90,000, the door opens for a much deeper correction, potentially down to the $88,000 or even $85,000 range, where we previously saw significant consolidation. On the upside, for the bulls to regain control, they need to push the price back up and reclaim $94,000, and then make a convincing break above the $95,000 resistance. Until that happens, the outlook remains cautious. For now, we are in a wait-and-see mode, watching to see if this crucial support of the 50-day moving average can hold. Now let's shift our attention to Ethereum. ETH is currently trading at around $6,820, down about 2.5%. Interestingly, Ethereum is showing a little bit of relative strength compared to Bitcoin today. While it is down, it hasn't fallen as sharply, and it's still holding comfortably above its key support levels. This relative strength can likely be attributed to positive developments within the Ethereum ecosystem itself. The recent Prog-Electra upgrade, which was successfully implemented last month, has been performing flawlessly, leading to a continued decrease in gas fees and an increase in staking efficiency. This has kept developer and user activity high. Furthermore, the narrative around the spot Ether ETFs, which began trading last quarter, continues to be a source of underlying demand, even if the initial inflows were more modest than some of the wilder predictions. From a technical perspective, Ethereum's key support level to watch is $6,500. This area was a major resistance zone that we broke through in late May, and the classic technical analysis principle is that old resistance becomes new support. As long as ETH stays above 6,500, its bullish market structure remains intact. The bulls will want to see the price reclaim the $7,000 psychological level to signal a continuation of the uptrend. If it fails to hold 6,500, however, it would likely follow Bitcoin down, with the next major support zone being closer to the $6,000 mark. For now, Ethereum looks a bit healthier than Bitcoin, but it is not immune to the wider market sentiment. If Bitcoin breaks down, it will almost certainly drag Ethereum with it, regardless of its strong fundamentals. Next up, let's talk about Solana. SOL has always been a high beta play on the broader crypto market, meaning it tends to experience bigger swings in both directions. That's exactly what we're seeing today. Solana is currently trading at around $285, down a more significant 5% on the day. Solana had an absolutely meteoric rise over the past year, and it's natural to see sharper pullbacks during periods of market uncertainty. The $95,000 rejection for Bitcoin was a signal for many traders to take profits on their more volatile altcoin positions, and Solana was a prime candidate. The Solana ecosystem continues to be a hotbed of activity, with a vibrant NFT market and a constant stream of new projects and meme coins launching on the network. However, the ghost of network instability still lingers in the background. While the affidavits of client upgraders dramatically improved performance and reliability, any period of extreme network congestion still makes investors a little nervous. The key level for Solana right now is the $275 support zone. This level has held firm on several previous dips. A break below this would be a significant blow to the bulls and could see the price quickly retrace towards the $250 mark. On the flip side, for the bulls to get excited again, they need to push the price back above the $300 psychological barrier. Solana's fate is closely tied to the overall risk appetite in the market. When sentiment is bullish, it flies. When sentiment turns fearful, as it is today, it tends to fall faster and harder than its large cap peers. Finally, let's cover XRP. XRP is, as always, the unique case. Is currently trading at $1.15, down about 3%, moving largely in line with Bitcoin. The story for XRP for so long has been dominated by its legal battle with the SEC. We now have a great deal of clarity on that front, with the final rulings having provided a pathway for Ripple and the usage of XRP in the United States. This legal clarity was a huge fundamental win, and it did lead to a significant price rally. However, we're now seeing a classic case of buy the rumor, sell the news combined with the headwinds of the broader market. The initial euphoria from the legal victory has subsided, and XRP is now trading more on its technicals and the overall market sentiment. It's struggling to break past the major resistance level at $1.25. This has been a stubborn ceiling for XRP for quite some time. On the downside, it has strong support at a $1.10 level. The XRP community remains one of the strongest and most dedicated in crypto, and they are focused on the long-term vision of XRP for cross-border payments and its role in a tokenized economy. But in the short term, it's caught in the same gravitational pull as everyone else. The bulls need to see a decisive break and hold above $1.25 to start a new leg up. Until then, it's likely to remain range-bound between $1.10 and $1.25, reacting to the moves of the market leader, Bitcoin. So, to wrap it all up and look forward, What should we be watching for? The immediate focus for the entire market is on Bitcoin and its battle with the 50-day moving average around $91,500. Whether this level holds or breaks will likely set the tone for the entire crypto market heading into the weekend. If it holds, we could see a bounce and a return to the consolidation range. If it breaks, prepare for another leg down as traders reprice their expectations based on the sticky inflation data and the looming Fed meeting. Next week will be all about the lead up to the Federal Reserve meeting. We will be listening intently to every word from Fed officials for clues about their thinking. Any hint of a more hawkish stance could send risk assets, including crypto, lower. Conversely, any unexpectedly dovish commentary could be the catalyst that finally pushes Bitcoin through its $95,000 resistance. My final thought for you today is this: periods of consolidation and fear are a normal and healthy part of any market cycle. They shake out leverage and allow for strong foundations to be built for the next move up. It's on quiet holiday weekends like this that the market often makes its most decisive moves. So, stay vigilant, manage your risk, and don't let short-term volatility distract you from your long-term strategy. We'll be here to track it all for you. That's all for today's update. I hope you found this breakdown helpful. If you did, please do me a huge favor and hit that like button, and make sure you're subscribed with notifications turned on so you don't miss our daily updates. And I'd love to hear your thoughts in the comments below. What are your price targets for these coins? Are you buying this dip? Or are you waiting for more clarity? Thanks again for tuning in. Enjoy the rest of your holiday if you're celebrating, and I'll see you all in the next video.